March 2nd, 2026, and the markets just closed with a chill running through them. Oil didn't just rise today, it exploded. Brent crude surged as much as 10%, WTI jumped roughly 9%, and global stocks slumped hard after the United States and Israel launched missile strikes on Iran, followed by reports that Iran attacked ships moving through the Strait of Hormuz. Let that sink in for a moment. The single most important energy choke point on the planet is now directly in the crosshairs of military escalation, and the world's financial system reacted instantly. When oil spikes this fast, it's not just about gasoline prices. It's about inflation, supply chains, central banks, currencies, and yes, your portfolio. Because when energy becomes unstable, everything else starts wobbling with it. And if you're holding stocks, metals, crypto, or even just cash, you are already feeling the ripple effects whether you realize it or not. Welcome back to Silver Signals. I'm Yali Jiang, and today we're breaking down exactly how world markets are reacting to the escalating conflict with Iran, what this surge in oil really means, why gold just made another explosive move higher, and where this could be heading next. If you care about protecting your wealth in uncertain times, this is one of those moments you do not want to ignore. And if you're new here, make sure you subscribe and join our growing global community of investors who believe in staying ahead of the curve, not reacting after the damage is done. Let's start with oil, because oil is the heartbeat of this entire story. Brent crude spiking 10% in a single session is not normal volatility. That's panic pricing. That's traders repricing geopolitical risk in real time. West Texas Intermediate jumping 9% tells you this is not a localized reaction. It's systemic. When missiles fly in the Middle East and tankers get attacked near the Strait of Hormuz, the market immediately starts asking one question: what happens if supply gets disrupted? The Strait of Hormuz handles roughly a fifth of the world's oil shipments. Imagine that for a second. One narrow passage of water, and nearly 20% of global oil flows through it. If even a fraction of that is delayed, threatened, or blocked, prices don't gently rise, they spike. Because energy markets are built on tight margins and continuous flow. Disruption equals shock. And here's the dangerous part. Oil feeds into everything: transportation, manufacturing, food production, heating, airlines, shipping. When oil jumps 10% overnight, companies that rely on fuel don't instantly adjust. Their costs rise first. That squeezes margins. And investors know this, which is exactly why stocks slumped today. We saw broad equity weakness as traders rushed to reduce risk exposure. When geopolitical conflict escalates, large institutional money tends to rotate out of high-risk growth stocks and into defensive assets. It's a classic risk-off move, and that's exactly what we saw as markets closed today. But here's where it gets even more interesting. While stocks fell, gold surged roughly 3%, climbing toward $5,400 per troy ounce. Think about that. A 3% move in gold at these levels is enormous in dollar terms. This isn't just a small hedge bid. This is serious capital flowing into safety. And this is something we've been talking about on Silver Signals for months now. Geopolitical conflict has been one of the core drivers behind gold's record-setting run over the past year. Wars, sanctions, global fragmentation, central banks diversifying reserves, all of it has created a structural bull case for gold. And now we have a new escalation in one of the most sensitive regions on Earth. When missiles hit, gold shines. That's not a slogan, that's history. But here's what most people miss. Gold doesn't just rise because people are afraid. It rises because conflict increases uncertainty about currencies. When oil spikes, inflation expectations, which can rise. When inflation expectations rise, central banks face pressure. Do they cut rates to support weakening economies? Or do they hold firm because inflation might surge again? That tension creates instability in fiat currencies. And when confidence in currencies wavers, gold becomes the neutral alternative. Now, I want to pause for a moment and ask you something. Do you believe this conflict will stay contained, or do you think it risks spreading across the region? Let me know in the comments. I genuinely read them, and I'm curious how you see this playing out. Because your outlook should shape how you position your investments. Let's talk about the US dollar next. In times of global conflict, the US dollar often strengthens as investors seek liquidity and perceived safety. The dollar is still the world's reserve currency, and when uncertainty spikes, global capital tends to flow into US treasuries and dollar-denominated assets. But here's the twist. If oil-driven inflation pressures return aggressively, the Federal Reserve could face a renewed policy dilemma. Higher oil can mean higher headline inflation. Higher inflation can mean tighter monetary policy. But tighter policy during geopolitical stress can strain markets further. It's a delicate balancing act, and currency markets are watching closely. Now let's shift to metals beyond gold, specifically silver. Silver often lags gold in the first phase of a geopolitical shock. Gold is the immediate fear trade. Silver is both a monetary metal and an industrial metal. So when stocks slump and growth expectations dip, Silver can hesitate at first. But if the conflict fuels sustained inflation or prolonged currency instability, silver tends to catch up and sometimes outperform. This is why I always say silver is like gold's more volatile sibling. When the monetary narrative strengthens, silver doesn't just move, it accelerates. And if energy prices stay elevated for weeks rather than days, inflation psychology could shift again globally. Now let's briefly touch on crypto. Cryptocurrency markets reacted in mixed fashion today. Some traders see Bitcoin as digital gold, a hedge against instability. Others treat it as a high-risk asset that sells off during market stress. That internal tug of war often creates volatility during geopolitical events. And right now, crypto is still trying to define its identity in moments like this. Is it risk on? Is it safe haven? Or is it something in between? The answer isn't fully settled yet. But I want to zoom out for a moment, because this is where the bigger picture matters. Geopolitical shocks don't operate in isolation. We're already in a world dealing with high sovereign debt, fragile supply chains, fragmented trade alliances, and shifting global power structures. When a major oil-producing region erupts into direct military escalation, it doesn't just create a temporary price spike, it exposes structural vulnerabilities. If tankers avoid the Strait of Hormuz for security reasons, shipping insurance costs rise. If insurance costs rise, transport costs rise. If transport costs rise, imported goods become more expensive. It's a chain reaction. And markets are forward-looking. They price not just what is happening today, but what might happen next month. This is why you saw such a sharp and immediate response in oil and gold today. The market is not waiting for confirmation of prolonged disruption. It is pricing the risk immediately. Now here's the surprising insight. The part most headlines aren't emphasizing. The real story may not be oil alone. It may be the psychology shift that comes with it. If investors begin to believe that geopolitical conflict is no longer episodic but structural, meaning not one-off flare-ups but an ongoing era of regional tensions, then portfolio allocations globally could shift permanently. Central banks have already been aggressively accumulating gold over the past year. If this conflict escalates or drags on, that trend could accelerate. And if central bank demand continues at elevated levels while retail investors wake up to geopolitical risk at the same time, the supply-demand imbalance in physical metals could tighten dramatically. That's the aha moment here. It's not just about today's spike. It's about whether this event reinforces a longer-term shift toward hard assets as a strategic allocation rather than a temporary hedge. Remember how we started this video? Oil exploding, stocks slumping, tankers attacked. That's the surface reaction. But underneath, something deeper may be forming. A re-evaluation of global risk itself. And here's the reality. We cannot control geopolitical events. We cannot predict missile strikes. We cannot forecast diplomatic breakthroughs with precision. But we can control how diversified and resilient our portfolios are. If you're entirely exposed to growth equities during periods of geopolitical escalation, volatility will feel amplified. If you hold a mix of hard assets like gold and silver, along with strategic cash positions, those shocks can feel more manageable. It's not about fear, it's about preparation. The world is entering a phase where energy security, currency stability, and geopolitical alliances matter more than ever. Oil spiking today is a warning shot. Stocks slumping are a reaction. Gold climbing is a signal. Signals, that's what we focus on here. So as we move forward from today's close on March the 2nd, 2026, ask yourself this. If tensions persist for weeks instead of days, how would your current portfolio perform? Would you be positioned defensively, or would you be scrambling after the fact? Because markets reward preparation, not panic. If you found value in today's breakdown, make sure you like this video so more investors can see it, and subscribe to Silver Signals so you never miss critical updates when global events shake the markets. Share your thoughts in the comments, especially on whether you think oil continues higher from here or cools off if diplomacy steps in. I truly want to hear your perspective. These are historic times in the commodities space. Volatility creates risk, but it also creates opportunity for those paying attention. Stay sharp, stay diversified, and as always, protect your wealth with intention. This is Yali Jiang, and I'll see you in the next signal.